Hey, so the Fed's minutes just came out from the November meeting, and there's a big shift in one particular thing that was just said by the Fed, and we got to break this down along with some of the other items. We'll break this all down in a quick summary here. I'm only going to mention it once in this video, so we're going to keep it to right here. Yes, Black Friday is in 2 days. Yeah, there's a 60% off coupon code. Yeah, I keep adding content. You get lifetime access. There are no monthly fees. You get live streams. If you join Elite Hustlers, which is to increase your income, you're going to get the live stream access to the Hustlers live streams and the exclusive content there and the course member live streams if you join before Black Friday. And all the other courses get the course member live streams as well, of course, for stock and real estate analysis. I will also be ringing the bell at the stock exchange on December 9th for market close. We'll do a public meetup outside at about 4:30. Depending on when things wrap up inside. And we'll be ringing the bell at 4 p.m. If you're a course member, you can submit a little thing in Discord, the little form, and you could come potentially for free. We'll be doing a raffle. Okay, let's talk about the Fed. The biggest shift from the Fed, and I'm surprised how few are picking up on this in the mainstream media, but it was the first thing that I noticed and tweeted about, and I'm like, this is a big deal. This is a big shift, is right here. This paragraph is critically important. With inflation remaining stubbornly high, the staff continue to view the risk to inflation projections as skewed to the upside. That's not new. That's old, okay? They've always said that the risk is inflation goes to the upside. Fine, that's the old part. For real activity, sluggish growth in private domestic spending, deteriorating global outlook, and tighter financial conditions were all seen as salient downside risks to the projection for real activity. Remember, the more real activity goes down, the less the Fed has to hike. And there is the possibility that persistent falling inflation could require a greater than assumed amount of tightening. Okay, so this is a backwards way of saying it is possible we have to raise rates more to get inflation down. Because of that risk, we are now saying, and folks, this is the first time the Fed has said this, they're now projecting that real activity risks on their baseline are equal to the potential chance that we enter into a recession sometime over the next year. We've also had the inversion of the 3-month 10-year, usually a really good indicator that a recession is about 9 months away. Now, I did translate that in English here. Basically, the Fed just told you, we think it's just as likely for us to have a recession, which means negative GDP and slower growth. And we think that is just as likely as our baseline forecast, which is no recession, positive GDP, but below trend growth. Remember, if trend is 3% GDP and we're growing at 2%, that's below trend. If we're growing at negative 1%, so shrinking, then we're in recession with 2 quarters in a row, right? Unless, of course, you're the White House. Then you don't believe you're in a recession when you have 2 quarters of negative GDP. But we don't want to get political. We want to focus on the commentary here from the Federal Reserve. Looking at some of the other notes, by the way, I encourage you to look at this page, very important, page 6 of the FOMC notes. You can get it at federalreserve.gov. So here, we notice the Federal Reserve is recognizing that one of the most important indicators in labor market conditions is showing that employment costs are beginning to fall. The ECI is known as the Employment Cost Index. It tracks hourly compensation and benefit costs, and it fell, or I should say, it grew at a slower pace. It was noticeably lower than the average pace seen over the first half of the year. This is very good and helps offset some of that risk of a wage price spiral. Now, the wage price spiral comment was added in the last minutes for the September meeting. And these notes have not changed. That wage price spiral argument is still here. They haven't made it worse. They haven't added to it. They haven't changed anything. They also 2 or 3 times mentioned this phrase that they added here in the FOMC statement that came out on November 2nd. And that was the statement that in determining the pace of future increases in the target for the federal funds rate, the committee will consider the cumulative tightening of monetary policy, the lags like unemployment and businesses slowing down and that, how long it takes for that to filter through the economy, and economic and financial developments. This is really important, and they mentioned a few times in this report that, especially with this paragraph here, and you could pause the screen here if you want to read this, but it's very important to realize the Fed does not have a historical record to tell us how long the lags are. And the Fed is being very cognizant of this. Not only are they being very cognizant of lags, but they're also saying, hey, look, we realize that prices for things like some commodities are coming down. We also realize that rents on new properties, on new leases are coming down. But we recognize that those show up with a lag. So commodities coming down, rents coming down, those take a while to show up in our favorite measure of inflation, which is PCE. That's their version of the Consumer Price Index. This is actually the Personal Consumption Expenditures report. So the Fed is being very aware that we have risks. And I think one of the things to know is Jerome Powell realizes he has the power to change his mind. Powell has the power to flip. And so what does that mean? Well, it's very simple. We can slow now, this is my opinion, to 50 basis points. If things get worse, we can always hike more. Say inflation gets out of hand, they could just rug pull us and go, that's it, we're raising rates 2%. They know they have that flexibility. But they also know, but we can also freeze hikes or reduce rates if we want, when we want. And a lot of this is going to be dependent on the December CPI report. And so if there's anything you do now, in addition, well, I'm not going to mention it again. I was going to mention it, but I didn't. I'm being a good boy. What you do want to write down and take advantage of right now is December 13th CPI report. The CPI report comes out 5:30 a.m. on December 13th, and then at 11 a.m. on December 15th, all these times, by the way, Pacific Standard Time. On December 15th at 11 a.m., we will have the FOMC rate meeting. This is where the market right now is widely expecting interest rates to go up by 50 basis points. That means we would see an increase from the present range of 3.75 to 4, up 50 basis points, 50 BPs, all the way to, just so you could see this visually, 4.25. There we go. To 4.5. I can't write well today. There we go. That's terrible. Anyway, right now the expectation is that we are going to see this 50 basis point hike with a 75.8% likelihood. We've also seen the Federal Reserve's terminal rate from this morning go from 5.24% as a market implied terminal rate down to about 5.15%. What else did the Fed tell us? Well, they told us that they saw that inflation expectations were relatively still anchored. We did see an increase in near-term inflation expectations, but that was likely due to CPI coming in higher. Do also keep in mind there are quite a few bullish things in this, or should I say dovish things in this. Like, hey, let's not go too hard. Let's realize that ECI is coming down, the employment cost indicator. Let's realize that things operate with a lag, like commodity prices coming down. The economy is starting to slow. We could always hike more in the future if we need to, but a lot of dovish things in this. But what's remarkable is even though we've got a lot of dovish things here, what do we have? This report actually was established. This meeting happened before the last CPI report, which is really, really incredible because the last CPI report we had a substantially below expectation release of the CPI report, and PPI thereafter about a week later came in also below expectations. So very, very good. I still pat myself on the back for nailing that CPI. I'm setting a high bar for the future though. That's going to be tough to nail that again. I was way outside the average economist estimates and still nailed both of the numbers. Damn. I should have played the lottery for that $1 billion lottery that week. A substantial majority of participants judged that slowing the pace of increases would soon be appropriate. And, some of them are saying, look, we probably need to slow down because we don't know what could happen. We don't know how we could affect financial stability. Remember that the United Kingdom had a financial stability disaster in their gilt market, which actually ended up leading the Federal Reserve, the Central Bank of England, and Mr. Bailey, the governor of the Bank of England, U-turning and basically having to print money. They ended up only printing $20 billion to bail out the bond market, but they said they would bail out the bond market by an infinite amount, and that was enough to stabilize the market again, which was very, very interesting. Yeah, you are seeing the 10-year Treasury yield bob around the lower end of about 3.7. I'm also curious how inflation expectations have moved. Remember, the 5-year break-even inflation rate is somewhat of a daily tool that we can use to analyze what inflation expectations are. And that rate has ticked down a little bit this morning. I'll go ahead, after these minutes came out, I'll go ahead and throw that on screen in a moment here. Well, I'd like to. There we go. All right, inflation break-evens on screen now, and oops, I think I used the wrong one because that was this morning's. My bad. I did. There it is. There's the appropriate one. Well, it actually shows you the difference now that I showed you both. I had both of them on my desktop. This is a zoomed in of the right. You could see that this morning we were kind of ticking up a little bit, and now we're actually ticking down a little bit. This is a big deal. I know this sounds like stupid. It's like, come on, man. It's like one chart. This is important, okay? Now, I guess since I told myself and you that I would not say anything else, I'm just gonna thank you for being here. Consider subscribing. I hope you found this useful. Oh, I should talk about the market really quick. Sucks for anybody who clicked out already. I think this is bullish. I think between now and CPI week, we're probably going to see a lot of institutions start moving money into the market. A lot of them are in a holding pattern. They're sitting. But I do think CPI week and Fed week is going to create a lot of anxiety. And so I wouldn't be surprised for you to see a sell down closer to the CPI period of time. Anyway, there you have it. Enjoy Thanksgiving tomorrow. Thank you so much for being here. I do appreciate you as a subscriber. And we'll see you in the next one. Goodbye.